I'm David McCreadie, CEO of Secure Trust Bank, and I'm pleased to share an overview of our financial performance for 2024. Our total results can be viewed on our corporate website. This year, we've achieved robust growth in our net lending and made significant strides towards our medium-term goals. First, I'd like to address the challenges in the vehicle finance sector so we can then focus on the positive achievements the Group has made in 2024. Like many in our sector, we face some challenges. The regulator's borrowers and financial difficulty review significantly impacted the financial performance of our vehicle finance business and therefore the Group's 2024 financial results. The ongoing legal and regulatory reviews on commissions added further complexity. We stopped discretionary commission arrangements back in 2017 and only 4% of our vehicle finance loans were affected by these arrangements. Regarding fixed commissions, just 20% of our motor commission payments are provided through dealers. We've made a £6.4 million provision in last year's numbers for discretionary commission arrangements and fixed commission structures. Today's results announcement provides full details. These challenges aside, our Group delivered solid growth in net lending. Other than vehicle finance, our three other specialist lending businesses all delivered profitability growth in the year. I'll now provide a strategic overview of the Group before diving into the highlights of our financial performance. Our strategic priority is to enhance the returns we generate by expanding our loan book towards our £4 billion net lending goal, which would support our target of achieving a 14 to 16% return on average equity. We are confident that the significant growth potential in the large addressable markets we operate in can propel us beyond this ambition in the future. Operational efficiency is also a key strategic goal. By maintaining a disciplined approach to cost management, we aim to achieve an ambitious cost-income ratio of 44 to 46% against a £4 billion net loan book. We continue to successfully scale our businesses. Over the last 4 years, we have achieved £1.4 billion in net lending growth, even amid macroeconomic uncertainty, high inflation and rising interest rates. We are now just 11% away from our £4 billion net lending target. We have also shifted our lending mix towards more consumer lending to support our net interest margin goal. Consumer lending now constitutes 53% of total lending, up from 41% in 2020 and 51% in 2023. Additionally, our deposits have shown strong growth as well, increasing by 63% over the same 4-year period. We made significant strides towards our medium-term goals last year, but more importantly, we have a clear pathway to achieving our target returns in the near term. Our focus is on aligning all key metrics on this pathway. Alongside reaching £4 billion in net lending, we also need to ensure a stable cost of risk. This metric was adversely impacted in 2024 by the secondary impacts of the regulator's borrowers and financial difficulty review. We are exploring structural changes in how we manage vehicle finance collection strategies going forward. Increasing our lending mix towards consumer businesses is another priority, and we've already made substantial progress in this area, as I mentioned. Managing our cost base is crucial, and I'm pleased to report that cost growth in 2024 was below the 5% level indicated in our pathway to medium-term targets. We are confident this trend will continue in 2025. We've accomplished a lot in 2024 and remain confident of achieving our targets. Lending growth, net interest margin, income growth and cost control all support that outcome. Our focus in 2025 will be on normalising the cost of risk. Now let's take a look at the key highlights of the Group in the year. 2024 was a year of substantial progress, with a notable improvement in profit before tax pre-impairments, especially in the second half of the year. Total lending balances grew by 8.8% to £3.6 billion, with growth accelerating in the second half. Savings balances also increased by 13% to £3.2 billion. We grew deposits faster than lending, enabling us to commence early repayment of TFSME funding ahead of the deadline during the second half of 2025. Profit before tax pre-impairments reached £101 million, an 18% increase from 2023, while operating income rose by 10.4%. Our net interest margin for the full year remained consistent with last year at 5.4% and was 5.5% in the second half of the year, which is in line with our medium-term target. As mentioned earlier, issues in the vehicle finance sector contributed to a lower risk-adjusted margin of 4.2% due to the inflated cost of risk in that business. Our cost-income ratio improved by 3.1 percentage points from 54% to 50.9%, and by the end of the year we'd achieved annualised cost savings of £5 million from our cost optimisation programme and committed to delivering a further £3 million saving in 2025. We also implemented a new progressive dividend policy last year. The board has proposed a final dividend of 22.5 per share, bringing the total dividend for the year to 33.8 per share, a 5% increase. Our return on average equity was 8%, impacted by the inflated cost of risk in the vehicle finance business. However, it's worth noting that our tangible book value per share now stands at £18.64, which is significantly higher than our share price. I believe these metrics clearly demonstrate the strong progress we made last year, guided by our strategic priorities, which focus on optimising for growth. We will be simplifying the group, enhancing the customer experience, and leveraging our distribution networks. These priorities support our long-term vision to become the most trusted specialist lender in the UK and our core purpose to help more consumers and businesses fulfil their ambitions. We've made significant progress in each of these areas, and the full details can be found in our report and accounts. However, I'll highlight a few key initiatives to illustrate our efforts. In terms of simplifying the group, Project Fusion has been a key driver, bringing cost efficiencies and streamlining our operations. A major initiative in 2024 was our organisation redesign, which unified all IT and operations teams under the group's Chief Operating Officer. This move has allowed us to adopt a more efficient, streamlined share service model. Enhancing the customer experience is a key priority, and we are continually looking for ways to help our customers in line with our core purpose. In our consumer divisions, we've made significant progress in improving the customer journey and automating processes, offering customers the convenience of self-service through digital channels. In our high-touch business finance division, providing specialist support to our customers is key, and our client satisfaction levels remain extremely high. In terms of leveraging our distribution networks, our efforts have been successful during the year. In retail finance, we extended contracts with key furniture and jewellery retailers, improving our new business market share to 15.3%. In vehicle finance, market share grew from 1.2% to 1.4%, and we now have over 400 active dealer relationships in stock funding, helping those clients to stock their forecourts. All of this progress has been enabled by technology, and in 2024 we continue to increase digitalisation and replace legacy platforms, further enhancing our capabilities. Looking ahead, there are some key points to leave you with as we move closer to achieving our medium-term targets. We're already seeing increased demand for credit following the recent base rate reductions, which will accelerate our growth trajectory. As we continue to expand our lending, our new organisational design will unlock further cost savings in 2025, leading to a further improvement in our cost-income ratio. In fact, our £3 million of additional savings are equivalent to a further 150 basis points improvement on this key ratio. We are confident that the cost of retail funding has peaked, and as a result, we expect to see net interest margin expansion in 2025. Additionally, several initiatives are underway to reduce the temporary increase in impairments in our vehicle finance business. We've already seen signs of improvement and are confident that the cost of risk will normalise in 2025. In summary, we have a clear focus on our specialist lending businesses, where we have proven our ability to win and gain market share. Despite the challenges faced in 2024, we have made strong progress towards our medium-term targets and are confident in delivering a significant improvement in our financial performance in 2025. I'd like to conclude by expressing my heartfelt thanks to my colleagues for their hard work and dedication throughout 2024. Their efforts have been instrumental in growing our lending balances while maintaining a strong focus on cost efficiency. Please do visit our website for more details on our 2024 performance.